Hello viewers, welcome back. We hope you enjoyed building up the compact DCF model. We find those models so incredibly useful for getting a basic overview of how a DCF works. Also, they are really practical when performing quick analysis. So what we are going to do now is we are going through some theory that we are going to need to build up in order to put together a full complex DCF model. So let's get started and we see what we have. So basically today we are going to look at the valuation. We are going to look at the valuation techniques. And these techniques, they are the valuations that we use when valuing a business or valuing an asset. We are going to use them either when we are valuing an asset or when we are valuing a business. So some of those valuation techniques, as you can see them, those are the ones that, some of the ones that we have. But for this course, we are basically going to focus on three, but we are going to look at two for now. We are going to focus on what we call we are going to look at, what we are going to look at here is we are going to look at some valuation techniques. And in fact, the three most common valuation techniques. Now, the three most common valuation techniques that are used to value a company would be comparable trading analysis. Comparable trading analysis would be the comparable trading analysis. The second one is the precedent. This is the comparable trading analysis. The second one is the precedent transaction analysis. And then the third one is what we call the discounted cash flow techniques, or the DCF analysis. Although there are many other techniques, as you've seen in this video here, because here we have also the ones that are cost-based, cost to build, replacement cost. So there are others, but as we said, the mostly used forms, there are those three: the precedent transaction analysis, the comparable, and finally the DCF analysis. Now, although we have these many techniques that are used to value companies, these three are the most common ones that we use in valuing the company. Now, this course is obviously about the DCF analysis. In other words, we are going to put more of our emphasis on understanding the DCF, or the discounted cash flow analysis. But in order to understand the DCF analysis, we need to have a decent understanding of how it fits together with these other two techniques. Now, here is a common question that you may get as a person who is working in finance. If we were to use these three techniques in order to assess the value of the company, would these three techniques give you the same or similar values for the company? That would be the big question. Now, the correct answer to this question would be no. In other words, it's much more likely that these three techniques will point you towards three different values for the same company. We need to understand why we have these results. We need to understand why each of the valuation techniques can actually give you a different result. Because after all, we are trying to measure the same company. And we are just measuring it in three different ways because the company is the same. Same company or same business, but using 1, 2, and 3 approaches, all the techniques. But now the challenge is, why all these give different results? This one gives you different result from this. Even this gives you different results. Yet we are valuing the same business. That's what we are focusing on. Now, let's try to do some small demonstration. We demonstrate how we can basically explain this so that everyone can actually be able to understand it well. Now, let's try to bring in these small diagrams, these small shapes that you are seeing down here. Actually, let me just change the color for this. So, we have those three diagrams. Let's suppose that we are actually not measuring or we are not trying to measure the value of the company. Let's pretend that we are trying to measure the height of the desk. This is our desk inside. And what I want you to get from this point is that if you're trying to measure the weight, sorry, the height of the desk, and we have three different options or different techniques that we are going to use. We are going to use three different ways to do that. First of all, we are going to use the measuring ribbon, this one. We are going to use the measuring ribbon here. That's a ribbon, measuring ribbon. And in the second one, we are going to use the ruler. This is our ruler here. So we are going to use a ruler, and at the same time, or the third technique, we are going to use a tape measure, measuring tape, or a tape measure. But all in all, what we want to look at is the height of the desk. Now, the height of the desk, essentially, you will find that each evaluation technique will give us some values there. In this example, the three different measuring techniques would essentially give us same results. Actually, from this point, all those three, they are going to give us same results. In other words, they are going to give us same height for the desk. So, the question is, why is it when we measure the value of a company three different ways, we essentially get the different results? Essentially, why is it that each valuation technique will give us such different result? We need to explore this and understand it. So what we are going to do to try to understand this is that we are going to try to understand exactly why these techniques yield such different results. First of all, we need to make sure that we understand what the techniques are. We need to first know, what are these techniques? What are the things behind these very techniques that we are using? So that's what we are going to first understand. Because after understanding what they are, we can be able to understand why they are giving us different scenarios. Because from this perspective, from this example that we have, you may find that most of these we have their conversion. If this one is measuring in centimeters, This one may measure in meters. Then we do a conversion and we have the same thing. So we want to understand some of these items. Comparable trading analysis. So want to look at each of these items in the valuation perspective, in the views of the person who does the valuation. So comparable trading analysis. The first one, what it is and why it could actually give us a different result. Comparable trading analysis essentially looks at the valuation for similar peer companies that are publicly traded. There must be publicly traded peer companies. You may find that those peer companies are those companies that are going to be in the same range, maybe in the same line of production, in the same range in terms of the size. Now, for precedent transaction analysis, this precedent transaction analysis is similar in that it does a comparison to peer companies. But instead of looking at where they are trading, it's looking at the past acquisition prices for those companies. Past acquisition prices for those companies. In other words, you look at similar companies, maybe same size almost, in the same line of production, and you look at the acquisition prices. So this is where we build a model of a company that forecasts. Now we look at the last one. Last one is the discounted cash flow techniques, or the DCF analysis. Finally, for the DCF analysis is where we are going to build a model that forecasts all future free cash flows. Future free cash flows. In other words, they forecast the future free cash flows, and at the same time, we discount those cash flows back to their present worth. In other words, we get the present value of all the future cash flows. So that's the implication, or that's what they basically mean in short term. So now that we have done a quick review of these three main techniques, let's start to investigate why they are different. First of all, comparable. Let me first move this. Now, for comparable trading analysis, this one right here is actually a relative valuation technique. It's a relative valuation technique. And this means that the value for the target company is really assessed relative to its peer and where they are publicly traded, or where they are trading in public markets. We look at the value, and it's supposed to be in relation to the peer and where they are trading in the public market or stock market. Now, similarly, even this one, the precedent transaction analysis, is also a relative valuation technique. And in this technique, the target company is valued relative to where the peers, in other words, they are relative to where the peers have been acquired in the past transactions. They look at the acquisition transactions or acquisition prices. And finally, for the DCF analysis, it is an absolute valuation technique. Sometimes it's referred to as intrinsic valuation technique. Intrinsic valuation technique. Intrinsic valuation technique. Essentially, we are looking at the target company, assessing its cash flows and discounting them back to a present value. And in this analysis, we don't consider the value of the peer. So it's not a relative valuation technique. So this explains partly why we get different results from these techniques, at least why we get different results from the DCF, because for it is an absolute valuation technique, and the other two, they are relative. But also it really doesn't explain why we may get different results, because especially in these two scenarios, in these two methods, because if these two, between these two techniques, between the comparable trading analysis and the precedent transaction analysis, we would actually find a compelling reason as why we are getting a different answer from those two perspectives, yet these are actually relative valuation techniques. But we shall also try to look at some of the advantages and disadvantages. So in the next video, we are going to discuss a little further and understand more about the difference between these three techniques. So we are going to look at the advantages of this over the other one. We see if we can basically get the right answer to why we actually end up having some of these answers differently. So let's meet in the next videos and we'll look at the various views of our value. So we'll see you in the next video.